It's been a crazy week on Wall Street. So crazy that a major hedge fund lost $4.5 billion dollars. It centers around the practice of short selling. This is where you bet that a stock will be worth less in the future than it is now. There's potential to make a bunch of money, but there's also potential to lose a lot more money. In general, it's a risky, shady practice that I wouldn't suggest anybody engage in. But it's a common practice on Wall Street and by major hedge funds. The firm in question that lost all that money is Melvin Capital, and they shorted a little company called GameStop. That company hasn't been doing very well, and so it seemed like a pretty easy bet that GameStop would lose value over time and eventually die out. Unfortunately, shorting stocks can be a way for a hedge fund or I suppose any other organization to purposefully kill off a company and make a lot of money doing it. Shorting a stock can have a negative impact just on itself of the value of the stock being shorted. Obviously, because it sends out signals that people are betting against it and it's not healthy, and it can almost kind of feed into itself. The problem with what Melvin Capital did, at least what it appears that they've done, I am not technical enough to know the specifics and the details or to confirm them. But word on the street is that they shorted GameStop for more shares of their stock than are in existence. When you short a stock, you attach a number of stocks that you're willing to bet on. But here, GameStop was shorted for more stocks than what was in existence, which is pretty crazy. What Melvin Capital did was incredibly risky or incredibly aggressive and immoral, attacking GameStop in this matter. So normally activity like this would fly underneath the radar, nobody would know, and these hedge funds would make a ton of money. But in the last few years, we could say that finance and investing has been democratized to a great extent. So much so that a little forum on Reddit called Wall Street Bets can get wind of how over-leveraged Melvin Capital was, and they can counterattack, so to say. They found out, or they got wind that Melvin Capital was so heavily shorting GameStop that they decided that if they pooled their resources together and invested into GameStop, the stock price would rise, and then Melvin Capital would be required to buy back these stocks at the higher price. But since there are more stocks being shorted than are in existence, each of these stocks would be, the demand for them would almost be infinite, since the price would almost be infinite because the demand is more than the supply can provide. And when you short a stock, you are in a contract. You are required to buy these stocks. And so if you can't buy stocks that don't exist, a lot of crazy things can happen. So that's the short story of it. There's a lot of drama around it. But I don't really want to talk about that. I want to talk about the idea that as the financial industry and investing has been democratized, I think a better word is decentralized. The power has been flowing from the Wall Street power structures into, let's say, the every man, every woman, and equaling out, at least when they act together in the case of Wall Street Bets. Melvin Capital losing all this money caused a lot of panic and moral outrage by, let's call them the ruling class or the financial class. And they believe, that there was probably fraud, and now Janet Yellen, she is the newly dubbed Secretary of the Treasury. She's head of the U.S. Treasury now, and she used to be head of the Federal Reserve years ago. She's having a meeting trying to figure out if any immoral or bad things, or like if there needs to be any more regulation or whatnot. And I would argue that we don't need any deregulation. We need deregulation. We don't need any additional regulation because I would say the responsible party, Melvin Capital, has already been punished way more than any government law or fine could ever punish them for. I think typically the federal government just fines companies for, let's say, financial shenanigans. And usually these fines are lower than the amount of money that these firms get for doing these shady things. And so they're almost incentivized to break the law and to do these things because the punishment will be so much less than the loot that they get. But in this case, the market hit back. Wall Street Bets purchased GameStop stocks. It rose, and Melvin Capital lost a lot of money. They even needed $2 billion in rescue funds from other hedge funds in order to not go under. This is the best signal to Wall Street to straighten up that I can think of at all. They lost an incredible amount of money, and that's what they value most, right? I think even if, depending on whether you're on the right or the left, we can all kind of agree that Wall Street values money above all things. And so that is perhaps the best way to let them get punished. And this punishment was provided by the free market, by the spread of information, by pooled purchasing power amongst individuals who are interested. And so I think this is a great thing. And while in this instance, there are a number of people, maybe even a lot of people on Wall Street Bets that bought GameStop, ended up losing money because they purchased the stock when I think I forgot this part. When the GameStop stock rose too high, Melvin Capital had to buy all these shares and pay off I think it's interest on their bets. The stock price skyrocketed, and this got a lot of people excited, and a lot of people purchased GameStop stock at the peak. And now that it's down, they've lost a lot of money, but there are a lot of people that have made a lot of money as well. And that's unfortunate. And I think that when you engage in the stock market, that is a risk that you take on willingly, and you shouldn't be bailed out for, and you shouldn't be prevented from doing. But either way, there's been pain felt on both sides, on Wall Street and on the Wall Street Bet side, the retail investor. I think that's the term for individuals buying into the market. And this is an inevitable sort of thing in the context of decentralizing finances or democratizing them. It's a power shift, right? From hedge funds, from Wall Street, from all these huge banks into the hands of the people. And I think it's a bit silly to imagine that a transfer of power in this way would be without corrections. And corrections include pain. They include negative outcomes as all of the interested parties figure out where the lines are, what's safe, what's not safe, what are the best ways to operate, what's risky. And this has been a big signal to Wall Street that they can't throw their weight around as much anymore, or at least in public, because they can be called on it, and to a great extent, much greater extent, punished for it than any regulator can do to them. Especially since typically Wall Street and this class of people typically write the laws. They influence the politicians that write the laws. But they have no sway or ownership of the masses. And so I think this is a really good thing. And in the long run, there will be an equilibrium and people will figure things out. And over the long term, even more power is going to be pushed down to individuals to manage their finances, to invest how they want. I think in general, Wall Street and the investment class are going to be less important going into the future, because now people have access to Robinhood and M1 and all these investment platforms that let them buy stock, even $1 at a time, which is a huge thing. And all these platforms don't have physical locations. And so all these banks and financial institutions that have expensive New York offices are going to have their lunch eaten eventually, because they're spending money on a lot of things that don't give them an advantage. So in short, this is a good thing. And I think it's a signal that going forward in the future, things are going to get better for the average person. And on a final note, if I could maybe add my little spin to this, I think this is perhaps an indicator that it would be okay to deregulate and create a separation of government and finances going forward, because, well, I think people do fear that if we deregulate markets or financial markets, a lot of shady things can happen. But I think this is a very concrete example of how the market will punish bad actors, or even risky actors that take too large of a risk. In a way, financial regulations shield bad actors and inefficient organizations, because they prevent them from showing their ignorance. It's like if you don't allow an organization to broadcast out to the world that they're a bad actor, or that they're risky, or that they're not good at what they do, well, then they can't fail. And their power is maintained because they're already large and they're protected by all these regulations that make it more difficult for other organizations to form. So if anything, deregulating would be highly dangerous for the the power structures in the financial system. And I think perhaps a bit of support to my point would be, I don't think that they would support large financial deregulations. I think they would fear that, and that they would actually fight against it. After all, they gave a ton of money to Barack Obama, and he ran on being tough on Wall Street. They gave a ton of money to Joe Biden. I think he said the same. And this is the party that wants to rein in Wall Street, and Wall Street's giving them the most money. So I think if you're following the money, that doesn't quite make sense. The party that wants to regulate an industry the most is getting the most money from them. All right, thanks for listening. Don't short any stocks, and I'll talk to you later. Bye.